far we've touched on market structure, then we've gone on to liquidity, and now it's time to move on to supply and demand. So we understand the level of importance that we do things here. It's structure, which is always number one. This leaves behind our supply and demand levels, which is number two. And then third off is liquidity and confirmation. So we've gone through structure to a super detailed and advanced level. We've truly learned how to build a narrative, build an understanding and a story behind what we see on the charts, how we're looking to take and get involved in our trades, the directions where we're positioned. All this is built around our structure. But now we need to learn, how do we get involved in our trades? Where do we get involved in our trades? And this is what structure tells us. And then our structure leaves behind supply and demand levels, okay? And what these zones are zones that are on the charts that we wait for price to come and tap into. And then when price is tapped into these zones, we look for our confirmation, which we'll move on to in the next section, which is after supply and demand. We look for our entry models, and then we look to get involved in our trades, okay? Now we have supply and demand zones absolutely everywhere across all time frames, on across every single financial market in the world, okay? There is so many unmitigated and relevant and irrelevant supply and demand zones on the charts, and the reason why structure is the most important thing that we learn is because these tell us which are the valid zones to trade in line with our structural idea. We need to make sure that we're trading the zones that are in line with our structural play, okay? And that is what our story and our narrative does. That'll come to make a lot more sense when we come in to do it and sort of piece it all together later on. But what we want to do is talk about the theory behind supply and demand zones, what we're going to be looking for on the charts when we implement it, and we sort of bring our structure involved with our supply and demand zones, and how we're going to look to draw these zones. So when we have bearish market structure, which is what we can see on the left, we can see we have lower low, lower high, lower low, lower high, and lower low. We understand from a structural perspective, we have a lower low. We come and pull back. This lower low is weak. We understand that we're looking to put in a new lower low and take the liquidity below this low. And we understand the high, if we just draw this on quickly, we understand that the high is protected. So this is a protected high and a weak low. We understand from a structural perspective, we are looking for a lower high, lower high before a new lower low. So where do we look to put in these new structural points? So where do we look in a bearish example to come put in this new lower high within the market? Well, this is where we look to find supply levels when we are in a bearish market. Now, how do we define a valid supply zone? What we are looking for is a buy candle before a sell, okay? So as we can see here, if we've had a break of structure, let's just say this was a break of structure, okay, what we are looking for in the swing structural point from the swing high to the swing low, we are looking for valid buy candle before a sell, okay? So as we can see here, we've had a buy candle before a sell, okay? And then if we have a look what's happened, we look for price then to come and tap into this level, okay, which is the buy candle before the sell, before we look for price to come and take it in the current structural direction. Okay, so all we are adding into this now is we are building on and drawing on our story and our narrative, and all we are doing now in a basic understanding for now, we're going to move on to fractal understandings of supply and demand later on, but all we are adding on to what we're doing now is understanding when we are in a bearish market, we are looking at supply levels, because when we get a bearish break of structure, we are looking for the last buy candle before the sell that's gone on and broken structure, or is part of the overall swing leg, okay? And we are looking for these levels from the swing high to the swing low, okay? And they're the buy candles before the sell, and we draw on these rectangular boxes to identify them. So I use, for a supply level, I draw on a red box, such as this, and then for a demand level, I draw on a blue box such as this. But all we're adding onto this now and understand is that we just have our bearish market structure, lower low, lower high, lower low. We understand we're looking for a new lower high before a new lower low. So what we can do is draw on these supply levels that we can expect to see to put in this structural play, which is going to be inside supply levels, which are the last buy candles before the sell, which we can see here. So we have a buy candle before a sell. We look for price then to come and tap back into that level, okay? Then we look to get involved in our trade before you can see price goes on and puts in its new structural play, which is to put in a new lower low. We then look for price to pull back. We can see then it's tapped into this buy candle before the sell, before price has continued on in its given direction. So what we've got to understand is that there is not going to be one supply level in each swing leg. You can have multiple supply levels in the same swing leg. And this is why when we move on to it, we never know exactly which levels are going to hold and which ones are going to fail. We stack confluences in our favor to understand which levels we could potentially see play out. There are lots of different things that we look for at how the POIs were created, or the supply and demand levels were created. We understand loads of different things using liquidity, using structure, using premium discount pricing to understand which ones hold more weight. And all we've got to do is understand and draw on the valid levels and then wait for price to come and tap into them. We understand from the confluences that we know which ones are more likely to hold, and then we look to get involved in our trades. So just understand, we never know exactly which levels are going to hold and which ones are going to fail. So if you draw on a zone and it breaks straight through it, it doesn't mean that your zone was invalid as long as it makes sense in your structural idea. You've just got to understand that the narrative or the delivery of price that is currently in action did not want to play from that level, and that's completely fine. And that is why we use confirmation, which we're going to go into later on, to confirm a zone. So it doesn't matter if we break through these zones and they don't play out, because we don't just take trades straight off these levels. We wait for price to confirm that price wants to go off one of these supply or demand levels, okay? So just understand that we can have multiple levels in a whole swing leg, and it doesn't matter if price breaks through your level or it doesn't even tap into your level, because all we're trying to do is just add this one step in. We understand the structural idea, which is the whole lower low, lower high, lower low, lower high, lower low. We understand that we're looking to put in this new structural lower high at these supply levels, which is simply the last buy candles before the sell, and then we wait for price to tap into one of these levels, and then these are the points that we could say, okay, this is now the point where we could see price come and put in the new structural leg, okay? And it's the same thing when we have bullish market structure. Same thing applies when we get a bullish break of structure. This leaves behind demand levels, which I've drawn and identified with a blue box such as this, okay? And it's vice versa to supply levels. What we are looking for are the last sell candles before the buy in the structural leg, in the swing leg. So we can see here, if we just again drew this on right here, if we drew this on like so, and we had this as a bullish break of structure, we understand from a structural perspective, what have we got? We've got a higher high, a higher low, a higher high. We're looking for a higher low before a new higher high. Where are we looking for price to come and put in this new higher low? Well, it's going to be inside demand levels, and these demand levels are valid demand levels, and they are identified with the last sell candle before the buy, okay? Like I said, you can have multiple of these within a swing leg, but it's the last sell candle before the buy, okay? When you've got demand levels, and like I said, it's vice versa for supply levels. It is simply the last buy candle before the sell, and demand levels are the last sell candles before the buy. So we can see here now, we've put in a new higher high, price pulls back. What do we expect currently? This to be a protected low. This is a weak high, so we expect to see a new higher low before a new higher high. Price is then put in a new higher high into the market. We understand from everything we know so far, all we're looking for now is for price to pull back, put in a new higher low before a higher high. So where do we identify the levels that we expect price to come to? Well, it's going to be demand levels when we're bullish, and they are levels that are the last sell candles before the buy, okay? Now, like I said, we could have multiple levels within a whole swing structural leg, and like I said, it's our job to wait for price to tap into these levels, look for confirmation to see if they want to hold, because it doesn't matter if they don't hold. Like I said, we'll go into confluences to which ones are more likely to hold later on, but just understand and be able to understand and draw them in line with our structure, which is what we're going to go into now. So if that didn't make sense, as always, we're going to take it onto the charts now, learn how to apply them onto the charts and see them play out for yourself, so you can see how we look to use them when we're in the markets.